Welcome everyone. We will be looking at the next segment within the budgeting and budgetary control chapter, which is the concept of variance analysis. And in particular, variance analysis again, this has been covered, at least the bulk of it. The work has been done in F5 and it's not really relevant for us at APM. At APM, we are all about budgetary control and that management control. How does the senior management exert control over the business? And in that process, there is actually one component of variance analysis that gets used, which is called planning and operational variances. So that is what is relevant for us. That is the only thing relevant for us in terms of variance analysis. But before that, since your syllabus dictates, we are going to very briefly recap variance analysis very soon. It's very straightforward. Variance analysis was introduced to you under the main heading and main subject of standard costing. So essentially, the concept was that at the end of a budgetary period, when you have actually gone through your implementation, what you can do is you can actually calculate your difference between the actual and the budget. So you had a plan and actually something happened, you calculate the difference, and that is what you call the variance. And then you analyze it. You see what can you learn from it, what went wrong, why was it tough, why was business down, or whatever, why did you do better. So for each cost element, for each revenue element, maybe on a product basis, on a service basis, on a departmental basis, you try to look at your budget, what you should have spent, or what you were planning to spend, or what you're planning to earn, versus what actually happened. Get the variance and analyze it. Very straightforward. You can go through the simple process. A quick reminder of some of the different types of budget variances. So if you remember, from revenue perspective, sales price, sales volume, cost, there were a bunch of variances you looked at. Let's see. This was all looked at under absorption and marginal costing, if you remember. So this is the snapshot of cost and revenue, right? Cost variances is basically should have cost versus the actual cost. That is your variance. For revenue, what was the actual revenue versus what was your planned revenue variance. If you actually earn more, it's a favorable. If you actually earn less than your plan, it's a unfavorable or adverse variance, we used to call them. So here you go. These are the different types of variances that you learned. So many actually cost variances, and okay, the calculations you can skip them. Even for fixed overhead, you calculated them, and then sales. These are the sales variances, sales price and sales volume variances. Okay, so that's essentially a recap. I can have this. This is just F5 content, so you can use them if you want to really recap. But our concern is really not there. Our concern is here, variance investigation. So that is what we will be really focusing on. Variances, when you really look at causality of variances, there are any number of reasons that could cause a variance, to a mathematical error, to poor budgeting, poor recording of costs, operational reasons, and random factors. And you should really consider significantly focusing on an investigation, a thorough investigation of a variance. If you consider that the size of the variance is too big, that the likelihood of the variance being controlled is quite likely, that you can actually exert a lot of control, that there is a likely cost of an investigation, but that cost is quite low and it's worthwhile spending that money to manage that variance. You can look at the interrelationship between variances. So if you find a variance that is affecting a lot of other lines, other aspects of the business, and causing a lot of other variances, it's really good to address that root cause variance. And what kind of standard that was set also, because if your budget was like ideal budgets and unimaginable budgets and things that you would never have achieved anyway and very impractical, then of course your variances are going to be adverse. In such a case, because of your budgeting problem, you shouldn't be spending too much time and effort on addressing or investigating your variances, because you're doing something that, however much you do it, the issue is not there. The issue is actually in the budget. So you should work on the budgetary aspect in that case, rather than investing on the variance itself. Okay. So this brings us to the planning and operational variance concept under the controllability principle, which is what we will be looking at in the next video. Thank you so much. Good luck.